Hey guys, welcome back to the Value Investor Show. Today I'm going to talk about two growth stocks that are crashing again. And here's what you guys need to know about the stocks, what happened, and what comes next. But before we do, I wanted to show you this latest article about Crocs. Crocs, I'm sure you've seen before, is essentially a flip-flop or shoemaker that creates the ugly shoe, which has been extremely trendy over the last few years. Well, recently their shares have fallen 30%. And I'm not flagging this because it's a stock that I'm talking about today, but because of what the CEO said on the call. The CEO said, "We see the US consumer behaving cautiously around discretionary spending. They're faced with current and future implied price increases, which we think has the potential to be a further drag on spending." The company has also predicted a 10% quarterly revenue fall that warns that poorer consumers are not even going to stores. So essentially, the company is facing a weaker US consumer. Price increases are also further dragging spending, and higher tariffs, elevated product prices, and reduced consumer spending are essentially significantly impacting their business. This has led to missed revenues and the predicted 10% quarterly fall. On the other side, though, a different business, McDonald's, has said something similar. They're also seeing the poorer US consumer cutting back on fast food purchases to save cash as a sign of strain at the lower end of the income spectrum. The chief executive said that lower income consumers to fast food restaurants continue to decline by double digits in the second quarter. Essentially, this shows that the lower income consumer is struggling. Disposable income is suffering, which is hitting mass market brands like Crocs, like McDonald's, extremely hard. They also pointed to wage growth not keeping pace with inflation and other economic factors affecting disposable incomes. I wanted to flag these articles because they show how the lower income consumers with less disposable income are directly impacted by the economy's growth and economic factors happening in the US right now. That's why I believe brands on the premium side have a competitive edge even with weaker economies, because they target simply a different consumer segment. They target the higher income consumer segment, which has higher disposable incomes. Which takes me to the first stock pick, which is Hims and Hers. Before we dive into the rest of the video, I want to thank today's sponsor, Fiscal AI. If you're serious about investing, this platform is a game changer. It gives you beautiful, clear graphs with all the KPIs you care about in absolute numbers and percentage changes. It has powerful forecasting tools so that you can project performance and even calculate a company's intrinsic value. It has industry benchmarks so you know exactly how a business stacks up, and it has detailed equity research papers with everything you need. Above all that, it's all integrated with AI so you can leverage AI in every part of your analysis. This is honestly a no-brainer platform. I use it every single day, and for a limited time you can get 15% off using my link in the description and pinned comment below. Don't miss it, sign up now. I wanted to talk about Hims because I've realized that on X there are a lot of advocates for this stock. Over the last week, the stock has dropped almost 30%. I think many advocates are not revealing certain risks to their audiences. Maybe they don't want to talk about those existential threats that these stocks could face in the future and instead focus on the short-term wins. Or maybe they just had a home run with this stock that they don't even care if it drops 30%. Well, to be fair, Hims stock tumbled after it lagged the second quarter sales forecast. However, profits did come above expectation. Hims is trading at a very high PE ratio for myself, but has very solid fundamentals. For example, 5-year CAGR growth and 3-year CAGR growth is more than 70% year on year, which shows that the company is executing extremely well. I mean, 70% revenue growth is just unheard of. The real question though for me is, can they keep growing at this level? And the answer is probably not. As you scale, growth at this rate becomes harder. Hims has been driven by amazing marketing campaigns, but marketing can only take a company so far in my opinion. They also have 1.1 billion in cash. They have limited debt. However, they have been diluting shares by increasing the shares outstanding, which for me is a red flag. I don't want the company that I invest in to dilute my shares. Their EV to sales ratio is fine, but their P ratio is extremely high for my liking. And in terms of return of assets, equity, and capital 5-year average is negative just because the company has only been recently positive. On a revenue and net income basis, revenue has increased steadily over the years, but over the last quarter, the company has seen the first ever quarter-on-quarter revenue decline. Net income was also above estimates and it was 3 times higher than last year, but memberships are growing while net income isn't keeping pace, which is something that I don't understand for the business, especially because it's a membership-led business. So I do expect net income to increase with revenue, but in this case it doesn't. In terms of expectation, analysts expect revenues to keep growing at 20%, but that's lower than the past. As I said, the fact that the company has been growing at 70+% has been gigantic, has been out of this world, but it couldn't sustain that growth for the foreseeable future. Subscriber growth has also slowed considerably. Monthly revenue per subscriber has decreased and retention could be the issue here. Yes, subscribers are growing, but the growth pace is just not the same as it used to be in the past. And I think this is one of the reasons why the stock is down 26% the last week. The second reason is that HIMSS forecasted for Q3 revenues of 570 to 590 million, which is just below analyst expectations. They also missed, as we said, the Q2 revenue estimates, as they reported 545 million versus the 551 million expected. And I think many of those problems weigh from the fact that they have abruptly ended the weight loss drug partnership with Novo Nordisk over disputes that they have had, as well as different allegations that Novo has said about HIMSS. Now, there are certain key risks that for me are very big to ignore. The first one being regulatory and legal hurdles. Any prescription rules or data privacy changes could increase costs significantly for the business, but even worse, it could change the whole business model. The second risk is competition. As more players in the telehealth and wellness could enter, they could drive price pressure for HIMSS and potentially lower profit as well as erode subscriber growth. The third risk factor is data breach risk. Being a data-driven company means it's a company prone to a cyber attack. If a cyber attack happened to HIMSS, it could cause not only massive reputational damage, but also massive financial damage. And HIMSS is a small company. It's not a UNH, for example, a United Health Group, which has ample of cash to settle any regulatory or breaches or fines that they have. If a big fine comes to HIMSS, it could be catastrophic. The final risk is that this is a company that is very much dependent on marketing. It has a very heavy reliance on paid ads, which means higher costs and potentially slower growth if marketing budgets are hit, or if there are new competitors coming in, or again, if there could be reputational damage due to some regulatory or data breach. Now, using Fiscal AI, I forecasted cash flows, I forecasted the revenue, I forecasted the revenue growth, the EBITDA margin, and I have put a multiple of 50 for the company. I expect the company to grow potentially 60% next year, 30% the year after, and then 20% aligning with analyst expectations. I've put an EBITDA margin of 6%, and that gave me an intrinsic value with the exit multiple approach of 26.5, which is very similar to my DCF model. It shows a significant downside from the current price. And to be fair, for me, this is not an entry point for this company right now. I know some investors have made a lot of money early on with this company, and kudos to them. But at this price, it doesn't make sense for me. I prefer another healthcare company, which I love and I've talked about many times, which is United Health Group, which trades below their intrinsic value. They also pay 4% dividend, and I have been buying heavily over the past few months. And that takes me to the second growth stock that I wanted to cover, which is trading like a waiting to die stock, which I do not understand why. It's Deckers Corporation. I've invested in this company at $101 and I bought more yesterday. The company is just a no-brainer for me. It has been growing 20 years at a CAGR of 16% for revenue and 20% for net income the last 20 years. I mean, what an incredible track record and leadership this company has had. I've been buying more as it drops, and I'm just very excited to fall again and buy more, as I do believe in the company. I believe in the future of their brands, and I just think it's a great financially established company. There's so many market concerns that I do not understand. In fact, bears are now saying that there are outside factors that are affecting their business. They're comparing Deckers to Crocs and claiming that Hoka is seeing slowing US demand. But here is what I see. Yes, demand has been growing at a smaller pace. In fact, domestic revenue only grew 3%, but international revenue last quarter it grew 50%, which is where the real opportunity lies. And yes, we are seeing domestic sales to staying relatively stable, but international sales are growing. This, even though it's a US based business, you have to remember Hoka is a brand that was created in Europe, and UGG, the other brand of Deckers, was created in Australia. So in a nutshell, there are consumer spending pressures in the US, and they are real. And we've seen that with Crocs, we've seen it with McDonald's. But the fact is, domestic growth was still positive year on year. And I think that's impressive for this company. And international growth growing at that level, 50% level year on year, it's just unimaginable. So using Fiscal AI, I separated Decker's revenue streams. Hoka's revenue has been growing 43% year on year since 2020, which is unheard of. And UGG has been growing almost 11%, which even for that, it's faster than Nike, it's faster than Adidas. So both brands are growing year on year, quarter on quarter. And this is why I love the company. They have two brands. They're relatively diversified, and both brands are growing impressively. But investors recently drove the stock down 50%, and it's because of a few reasons, and that's why it created a massive opportunity for me to enter. The first one is that leadership said earlier this year that it expected 150 million in additional costs, raising margin concerns due to tariffs, as they're a Vietnam-based sourcing company, and this was downplayed in the Q1 earnings call, as they said they have mitigated most of the costs. However, they did stay a bit cautious with the whole tariff situation, with a lot of uncertainty, and this is one of the reasons why it has dragged down the stock. The second reason is that they anticipated slower direct-to-consumer demand for Hoka. The near-term revenue growth decelerated, partly due to weaker consumer sentiment and shifting buyer behavior. And thirdly, they have provided after 2026 guidance. Earlier this year, the CFO provided mid-teen sales growth for Hoka and mid-single digit sales for UGG in 2026, which has spooked investors. But to be fair, when you see the Q1 picture of 2026, it does tell a different story. So as I said, Hoka sales increased 20% year on year. UGG sales increased almost 20% year on year. And while other brands' net sales decreased 20%, it's just a minor percent of the total revenues. Overall, net sales increased 17%. And the number I loved the most is international net sales increased 50%. I mean, this is insane. This is insane growth for a company that is growing internationally. And I think the opportunity lies on international sales. That's where the opportunity is for the company. It's not on domestic sales, which have decreased 3%, but instead it's internationally. In fact, this is an international business. Gross margin has been only slightly impacted, and the company has 2 billion in cash while has no outstanding borrowings. So this is a company that has an A-star balance sheet. It has an A-star income statement and cash flow statement, and in terms of valuation, I think it's very attractive. Now, all the gains since that amazing Q1 results have essentially been erased. The company skyrocketed to almost $120 per share. I was up 20% in a day, but then it has now erased all of that gain. So guess what? I've added more to my position at $101. And for me, my conservative base case shows that even with revenue, EPS, and free cash flow growing at 8 to 11%, which for me is very conservative given what we have seen in the numbers for Q1 and a discount rate of 8% and the margin of safety of 50%, my average intrinsic value with margin of safety comes at $109, which is why I have been buying more at around 100, and my 2030 target is at least $250. I do expect this investment to bring at least 2 to 3 times my money. And to be honest, I'm here for the journey. I love the stock. I love the company. I own Hoka's myself. I know how good their brand is. And I'm just very excited for the future. Thank you for watching this episode. If you've enjoyed it, please leave a like, subscribe, and comment. I always respond to comments, so I do look forward to hearing your thoughts. And do follow me on X. And if you would like to donate, I always shout out my donations. So thank you so much for your support over the last few weeks.